Hi everyone, welcome to our Chapter 5 overview video. So in Chapter 5, we are going to take a look at really three different things, all having to do with accounts, receivables, and sales. So the first thing we're going to do is we're going to take a look at sales returns, allowances, and discounts. And then we're going to look at accounts receivable in detail, including what happens when your customers don't pay you. Finally, we're going to take a look at notes receivable and the interest revenue that goes along with them. All right, so first of all, what is accounts receivable? Hopefully you remember that accounts receivable come about when a customer has been provided. So your company provided a service or goods to a customer, but the customer has not yet paid for it. In some cases, it's very common. In other cases, it's not that common, right? Your local retail store probably does not have that many receivables, but a big company that sells to other companies often has very large receivables. All right, so when are receivables recorded? Well, hopefully you remember that receivables are recorded at the time of the sale. So if you provided a service, the company provided a service, or the company delivered some goods, then the accounts receivable would be recorded at that point. And finally, why, you might be wondering, well, why do companies do this? Well, think about it. Think about, you have a company and you're going to be, let's say, buying merchandise from another company. So if you had to pay cash for that merchandise, it would be much harder on you than if you were able to have credit, because some companies can actually sell the things that they buy and get the money for that before they even have to pay for the goods, right? So companies sell on credit because it increases their sales, all right? It gives them more access to more customers because the customers have the opportunity to pay, say, within 30 days. All right, so we're going to take a look at these different kinds of discounts. So sales happen, right? Sales happen, and then these other things affect the amounts of our sales, or at the same time. So we're going to look at these four items, starting with trade discounts. So trade discounts are simply a reduction in the selling price. The nice thing about trade discounts is that you don't have to account for them separately. So trade discounts might come about if, say, a customer buys a certain amount of things, so it could be a quantity discount. It also could be a trade discount in that you're in the trade. So for example, if you're a carpenter and you go into Home Depot, you're not paying the same price as the average homeowner is paying at Home Depot because you're in the trade, so you get a discount. So in this case, the sale is recorded at the lower price. There's no separate accounting. Now let's contrast that with sales discounts. Sales discounts come about when a company offers its customers a discount if they pay early. So an example, 210 net 30. 210 net 30 means the customer would get a 2% discount if they pay within 10 days. Otherwise, they have to pay the net amount or the whole invoice within 30 days. So if the customer pays within the discount period, a sales discount results. This is good for the buyer and the seller. Hopefully you're thinking, why is it good for the buyer? Why is it good for the seller? Well, it's good for the buyer because the buyer gets a discount, right? They get a 2% discount and they only have to pay 20 days earlier, right? And the seller gets the benefit of receiving their cash sooner. So this is a benefit to both the buyer and the seller. So sales discounts come about when the company offers its customers a reduction in price if they pay their receivable early. Or to them it's a payable, to the company it's a receivable, right? Okay, so then sales returns and allowances, you're probably familiar with this. If you've ever gone into a store and bought something and then at some point you decided you didn't want it, or you got home and say you tried on something at the store and you got home, you didn't like the way it looked anymore, maybe you went back to the store and returned it. Well, that would be a sales return. So a return is any time a customer returns goods, and the customer would get either cash. So if you were talking about a store, it would be cash, but if it was another business, they might get credit against their receivable, right, or their payable. So say that company A sells something to company B. but company B hasn't paid for it yet, right? And then they return some of the stuff. So company A gives them a credit. All right, so an allowance is very similar, except that an allowance means something was not right with the merchandise, but the customer decides to keep the goods anyway. So let's say your company shipped 50 blue t-shirts to another company, and they call up and they say, hey, we didn't order blue t-shirts, we ordered black t-shirts. So you say to them, all right, listen, keep the t-shirts, we'll give you a discount. All right, so the difference here is that the customer gets a reduction in the price, but the goods are not returned. Okay, so in the case of a return, the customer returns the goods, but in the case of an allowance, the customer does not return the goods. All right, so let's see how all of these look on our financial statements. So here's an example of an income statement with all of those items on it. So your sales revenue is at the top, just like it always is. And then we have all of these reductions in our sales. These accounts, sales discounts, sales returns, sales allowances, are all called contra revenue accounts. They go against your revenue. They reduce your revenue. Okay? If you remember that revenue has a credit balance, then you'll be able to understand that these three accounts all have debit balances because they reduce your revenue. All right, so net sales is what we call sales after we take out all of these three items. Now, every company is not going to have all three of these. Some companies may not offer sales discounts, but whichever ones you have, you subtract from your sales to get your net sales. All right, so now let's talk about the allowance for uncollectible accounts. So not all receivables are going to be collected by a company. Why? Just all customers are not going to pay, right? So the company does not want to show on its balance sheet, well, it might want to show, but it's not proper to show 100% of your receivables as receivable when you know you're not going to collect all of them, right? So we have to account for these receivables that will not be collected. This gets a little bit complicated, so make sure you take your time with this. All right, so the allowance for uncollectible accounts, this is another new account for us. And what it does is it holds the amount of our receivables that we believe will not be collected. This is one of many times in accounting where you're dealing with estimates. So people tend to think accounting is black and white. Accounting is not black and white. The more you learn about it, the more you'll find out there's a lot of judgment involved. So the company estimates how much of its receivables will not be collected. And that's the amount that goes into the allowance. The allowance is a contra asset account. So now we've seen two different kinds of contra accounts. So remember, the contra goes against. The contra asset account goes against the accounts receivable. Think of a contra account. A contra account has to be married to another account. It doesn't live by itself, right? So remember the contra revenue accounts, there has to be revenue for those to be married to, right? And it's the same thing here. The contra asset account needs something to go against, and in this case, it's accounts receivable. So remember, receivables are an asset. They have a debit balance, and so the allowance is a contra asset with a credit balance. All right, so let's see what happens. At the end of a period or the end of the year, the allowance is set up for the amount that the company believes will not be collected. So they debit another new account here called bad debt expense. Bad debt expense represents the amount of money that the company believes will not be collected. So we want to match this expense. Remember the matching principle, or the expense recognition principle. We want to record this expense in the same year as the revenue. So we recorded the revenue, and now we're going to record the expense. We credit this allowance for uncollectible accounts. This is an adjusting entry, everybody's favorite. Remember, adjusting entries affect one income statement account, that's your expense, and one balance sheet account, that's your uncollectible accounts. So remember, at the end of every year, any company that has uncollectible accounts is going to be making this journal entry. Now, let's see how they decide how much to make how much this journal entry is made for. All right, so we're going to ask 3 questions. Number 1, how much do we need in the allowance? How much do we think is uncollectible? Then we're going to compare that to how much is already in the allowance, because the company already has an allowance set up from prior years, assuming it's not the first year of business. And by comparing those two, we find the amount of the adjustment. So let's take a look at a couple of examples. Let's say our allowance for uncollectible accounts has a $2,000 balance before adjustment. At the end of the year, we determined that we need $10,000 in that allowance. So we think $10,000 of our accounts receivable will not be collected. All right, so hopefully you understand your T accounts well enough. We have $2,000 sitting here, but we need $10,000. So what does that mean? We have to adjust it for $8,000. So our adjusting entry, our debit to bad debt expense and credit to the allowance for this company at the end of the period is going to be $8,000. All right. It might help you to remember that if you have a credit balance in the account, you have to subtract to get your answer, right? The way we got this $8,000 was to subtract $10,000 minus $2,000. Now let's look at what happens when we have a debit balance before adjustment. So same situation, except that before we make our adjustment at the end of the year, there's a $1,000 debit balance. All right, so now we want a $10,000 credit balance, but we have a $1,000 debit balance, effectively a negative balance, right? So if you want to go from negative $1,000 to positive $10,000, your adjustment has to be $11,000. So you can remember that when you have a debit balance, you have to add these two together to get the amount of your adjustment. And if you're ever having a hard time and you're not sure, just put the amount in and see what your balance is, right? Here we have an $11,000 credit, a $1,000 debit, and that gives us $10,000. All right? Okay, so there's a method of figuring out, remember what we want to know. Let me go back a second. I know it's a lot of clicks, but let's go back here. How much is needed in the allowance? Well, how much is needed is some percentage of what's in there based on what's happened in the past. Okay? So here's one possibility. This is called the aging method, and this one's the more complicated one. So if you understand this, then you can do the easier one. The easier one is just one percentage. The aging method has a bunch of different percentages. So let's look at what's here. What do we have? We have a bunch of patients, any kind of customers. Those are your customers. And then we have the amount they owe us and how long that's been outstanding. So these ones here are not yet due. So that means the patient must have just come in. We sent them a bill. The bill isn't due yet. Then we have some that are 1 to 60 days overdue, some that are 61 to 120, and some more than 120 days overdue. What happens to the likelihood that a receivable is going to be collected as it gets older? Well, it's less likely that it's going to be collected, right? If a customer hasn't paid you and they're 120 days, so like 4 months overdue, it seems that based on their experience, 70% of those receivables are not going to be collected. And so we start with the lowest percentage. Those are the recent ones. So we know that 10% of all of our receivables won't be collected, and then it goes up. So now how do we find this 5 million is the same as the 10,000 we were just looking at. The 5 million is the amount that we want in our allowance at the end of the year, because that's how much we believe is uncollectible. How did we get that? Well, each of these are multiplied, right? Multiply down, and then we add it across. So what they're saying here is that they estimate that $5 million is not going to be collectible. And as we noted, the percentage increases with age, and the total estimated uncollectible for this particular company at this point in time is $5 million. So that's the aging method. All right, let's talk about write-offs for a minute. A write-off means that you know that your customer is not going to pay you. Well, you're pretty sure the customer is never going to pay you. Maybe they're out of business. Maybe you tried to collect many, many times and there's no response. And you're thinking, okay, these guys are not going to pay us. So what do? They write the account off. meaning they take it out of their records. The account doesn't exist anymore. So how do they do that? Well, they credit accounts receivable, because remember, receivable has a debit balance, so we're going to credit accounts receivable to take it off our books, and we debit the allowance. Be very careful here. We're debiting the allowance. Why are we debiting the allowance? Because that's what the allowance was set up for. Remember, the allowance represents the estimated amount we think is going to be uncollectible. Sometimes students want to debit bad debt expense here. Do not do that. Remember, bad debt expense is only debited at the end of the year when you set up your allowance. Okay? So if a customer is not going to pay us, we write off the account, we debit the allowance, and we credit accounts receivable. Now, sometimes you might write off an account and the customer comes through and pays after all. So in that case, that's what we're looking at here. There's two things that have to be done. Basically, you're going to record a collection of a receivable, right? That's this here. We can't record a collection of a receivable if we don't have a receivable, because remember, we took it off our books. So we have two things we have to do here. First, we have to reestablish the receivable that we thought was gone. So we're reversing the write-off. This is the reverse of the thing that we just looked at. Remember here, we debited allowance, credit accounts receivable. Now we're doing the opposite. We're putting the receivable back on our books. And then we record our collection as we always do. Debit cash, credit accounts receivable. Our cash is going up, and now our accounts receivable is going down. All right, so let's look at the allowance method, which is GAAP, generally accepted accounting principles, versus the direct write-off method, which is not. Now, we have been looking at the allowance method because that's the method that we have to use for accounting. And if you look at any big company's financial statements, they are using an allowance method. So what do? We estimate our uncollectibles and we record our bad debt expense at the end of the period. We adjust the allowance at the end of the period to represent the amount of uncollectibles, and then our receivables are reported on our balance sheet at what we call net realizable value, the amount we actually expect to realize, which is our accounts receivable minus our allowance. Okay, so this is our GAAP. Now, there is such a thing as a direct write-off method, which is not GAAP. Who's using direct write-off method, and why are we even talking about it? Let me give you an example. Let's say you have a local mom and pop shop. Like our family used to have a bicycle store, and pretty much for a bicycle store, you don't have any receivables, right? Your customers come in, they pay you with credit card or cash, and that's it. The transaction is over. Once in a while, we would have a receivable. So, for example, a local gym would come and say, we want to buy X number of exercise bikes from you. And so we would have a small receivable for some period of time. All right. So in the case of a business like that, you could use the direct write-off method because for the most part, you don't have any receivables and it's immaterial, meaning that it's so small, it's not going to matter. If the company, even so, if the company were going for a loan and they needed GAAP financials, they would have to still account for the for uncollectibles if they had any receivables on the book. So what does this mean, this direct write-off method? What it says is you only record the bad debt expense when an account becomes uncollectible. There is no allowance, and so the receivables are reported at their full amount. Well, hopefully you could see how that is not right for GAAP, because if you're not going to collect 100% of your receivables, then certainly you don't want to tell people that that's the amount you're going to collect. So the direct write-off method, don't worry too much about it. But do remember, this is the thing that gets students sometimes, which is the direct write-off method, you debit bad debt expense when the account becomes uncollectible. But remember what we said is that when you write off an account using the allowance method, you have to debit the allowance, not bad debt expense. Okay? All right. So accounts receivable summary, remember that accounts receivable is a current asset. The allowance is a contra asset and it goes against the accounts receivable, and this is what your balance sheet would look like. So under current assets on your balance sheet, you would have your accounts receivable. less the allowance for uncollectible accounts, which would give you net accounts receivable. So this company thinks of its $200,000 of receivables, it thinks it's going to collect $190,000. That is its estimate, right? Finally, bad debt expense is just simply an operating expense like any other expense, like salaries, like rent, like advertising, any other expense like that, and it just goes on the income statement with the rest of your expenses. All right, finally, let's take a look at notes receivable. So notes receivable represent amounts owed to the company, but it is a formal note. So somebody signed a note and said, I owe you X amount of dollars. I'm going to pay you this much interest per year, and I'm going to pay you back in this amount of time. All right. Notes are recorded at their face value always. So if somebody borrowed $10,000 from you, the note is debited at $10,000 and it stays at $10,000. Okay. Recorded at the face value, they stay at face value. Notes receivable, just like accounts receivable, are assets and they have debit balances. Now, the thing with notes receivable is they could be long-term or they could be current. So it depends on how long it's going to be until the note is collected. So if the note is, say, a 3-month note, it would be a current asset because it's less than a year. If it's a 2-year note, then it would be a long-term asset. Okay. Notes bear interest. And so remember I said when you sign the note, you would have a note of $10,000. I'm going to pay you back in 3 months with 10% interest, right? So there's interest revenue associated with the notes. Finally, the interest calculation, this is the thing to be a little careful with the notes, is principal times rate times time, which I'm sure you've heard of before. Now, the thing I want you to keep an eye on here is this. The time is part of a year because your principal is the amount of note. So like we said, $10,000. Your rate is 10%, right? Whatever your interest rate is. Those things are easy. The time is the thing that gets students because you have to remember that interest rates are always stated in terms of, they're always a year. Okay? So if I say I'm loaning you money at 10%, even if it's only a 3-month note, the 10% is per year. So remember that your time has to be in terms of a year. And you'll see that in your guided notes, in the example in your guided notes. Okay? All right, that's all I have for Chapter 5. I hope you find it helpful, and I'll see you next time.